Have you ever looked at your bank account and thought, there's got to be a better way to grow this money than letting it sit there earning 0.01% interest while the bank uses it to make billions? You're in the right place. If you've ever wondered how people actually become wealthy without winning the lottery, inheriting money from a mysterious rich uncle, or somehow getting lucky with a viral TikTok that leads to brand deals, stick around. By the end of this video, you're going to understand not just what investing is, but how to actually do it, the strategies that work, the mistakes that will destroy you financially, the psychological traps that make people buy high and sell low, and most importantly, how to start building real wealth starting today, even if you're beginning with almost nothing, even if you're in debt, even if you think you're too far behind to ever catch up. And look, I get it. Money is scary to talk about, it's taboo, it's personal, it makes people uncomfortable. Investing feels risky. What if you lose everything? What if you make the wrong choice? What if you're not smart enough to figure this out? What if all those finance bros on social media are gatekeeping some secret knowledge that only the elite understand? Here's the truth that nobody wants to tell you. The biggest risk isn't losing money in the stock market. The biggest risk is doing nothing and watching inflation slowly erode your purchasing power while you work your entire life, trade your time for money, climb the corporate ladder, and have nothing to show for it at the end, except maybe a gold watch and a social security check that can barely cover your groceries. So let's fix that. Let's turn you from someone who's afraid of investing, who doesn't understand it, who thinks it's not for people like you, into someone who actually knows what they're doing. Someone who can look at their portfolio and understand exactly what's happening. Someone who can make informed decisions, instead of just hoping for the best or listening to random advice from their uncle who knows a guy. Sound good? Alright, buckle up. And if you're getting value from this, hit that subscribe button. Seriously, it helps the channel grow, it helps more people find this information, and it ensures you don't miss future content that could literally change your financial life. Plus, it's free, and it takes less effort than you spent deciding what to watch on Netflix last night. Alright, let's dive in. Part 1. The brutal truth about money that nobody teaches you. Chapter 1. Why you're probably poor, and it's not entirely your fault, but it's becoming your responsibility. Let me start with something that might sting a little bit. If you're working a regular job and not investing, you're on a financial treadmill. You're running as fast as you can, sweating, getting tired, maybe even getting promoted and running faster, and going absolutely nowhere in terms of building actual wealth. And here's the thing I need you to understand. It's not entirely your fault. Nobody taught you this stuff. Your parents probably didn't know it because their parents didn't teach them. Your teachers definitely didn't teach it because they were too busy making you memorize dates of historical battles that you'd forget immediately after the test. And society has basically set you up to be a worker bee who trades time for money until you're too old and tired to work anymore, at which point you retire with hopefully enough savings to not eat cat food and live in a cardboard box. Here's how the system works, and I need you to really understand this because once you see it, you can't unsee it, and it's kind of messed up. You go to school for 12 years minimum, maybe 16 or more if you go to college or grad school. You learn calculus, chemistry, history, literature, all sorts of stuff that you'll mostly forget within a few years because you never use it. But you don't learn about compound interest. You don't learn about tax optimization. You don't learn about how to build wealth or achieve financial independence. You don't learn about the difference between assets and liabilities. You don't learn how rich people think about money differently than poor people. Then you graduate, hopefully without crushing student loan debt, but probably with some, and you start looking for a job. You put together a resume. You go through interviews where you pretend to be passionate about working for this company even though you just need money to pay rent. You get hired if you're lucky, and now you're in the system. You trade your time for money, 40 hours a week, sometimes more if you're salaried, and they guilt you into working extra without additional pay. 50 weeks a year because you get 2 weeks of vacation if you're lucky, 1 week if your company is cheap. For 40 or more years of your life until you reach retirement age. You wake up to an alarm you hate. You commute in traffic that makes you want to scream. You sit in meetings that could have been emails. You deal with coworkers who drive you crazy and bosses who don't appreciate you. You eat lunch at your desk while checking emails. You commute home in more traffic. You're too tired to do anything except watch TV or scroll social media. You go to sleep. You do it again the next day, and if you're lucky, if you play your cards right, if you don't get laid off or sick or divorced or hit by any of the million things that can derail your finances, you'll make enough money to pay your bills, save a little bit, and maybe retire at 65 with enough money to not be a burden on your kids. That's the dream they sold you. Work hard, be loyal to your company, save your money in a bank account, don't take risks, play it safe, and you'll be fine. Except there's a massive, gaping problem with this plan that nobody talks about: inflation. Inflation is the silent wealth killer that destroys your financial future, without you even realizing it's happening. It's the reason your grandparents could buy a house for $20,000 and now that same house costs $400,000 or more. It's the reason a movie ticket used to cost $1 and now costs $15. It's the reason your parents could pay for college by working a summer job and now college costs more than a luxury car. Every single year, the purchasing power of your money decreases. On average, inflation runs about 3% per year historically. Some years it's higher, like recently when it hit 8% or 9%, and suddenly your grocery bill doubled. Some years it's lower, but it's always there, slowly eating away at your wealth like termites in the foundation of a house. That means if you have $10,000 sitting in your bank account earning 0.5% interest, which is generous for most savings accounts, you're actually losing 2.5% of your purchasing power every year after accounting for inflation. You're going backwards financially while thinking you're being responsible. In 30 years, that $10,000 will still say $10,000 on your bank statement. The number won't change. But in terms of what it can actually buy, in terms of real purchasing power, it'll be worth about $4,000 in today's dollars. You lost more than half your money by doing the safe thing. You worked hard for that money. You saved it. You were disciplined. You didn't blow it on stupid stuff. You did everything you were told to do, and it still lost more than half its value just sitting there in your safe savings account. That's the trap. That's the hamster wheel. That's why people work their entire lives and never get ahead. They're saving money in a system that's designed to make that money worth less over time. The game is rigged, and nobody told you the rules. Now, you might be thinking, okay, so what's the alternative? Just spend everything and live for today? YOLO my way into poverty? No, that's even worse. I'm not telling you to go blow your money on stupid stuff, finance a BMW you can't afford, or buy the latest iPhone on credit. What I'm telling you is that you need to make your money work for you instead of just working for money. You need to stop being a worker bee and start thinking like an owner. You need to understand that the wealthy don't just save money, they deploy money. They make their money go out into the world and bring back more money. And that's what investing is all about. Chapter 2. The investing mindset shift that changes everything. Before we get into the specific mechanics of how to invest, what to buy, which accounts to open, and all the tactical stuff, you need to understand a fundamental shift in thinking. This is the difference between people who build wealth and people who stay broke their entire lives, even though they make decent money. This is the difference between someone making $50,000 a year who becomes a millionaire and someone making $150,000 a year who's perpetually broke and living paycheck to paycheck. It's not about how much you make, it's about how you think about money. Poor people think about money as something you earn and spend. It's a linear transaction. You work, you get paid, you buy stuff, the money's gone, repeat. Time for money, money for stuff. Stuff eventually breaks or becomes obsolete. Get more money, buy more stuff. It's a cycle that never ends and never builds wealth. They live paycheck to paycheck, not necessarily because they don't make enough, but because their mental model of money is consumption-based. Money comes in, money goes out. That's life. They might want to be rich. They might dream about being rich, but they don't have a plan to get there because they don't understand the mechanics of wealth building. Middle-class people think about money as something you earn, spend some of, and save the rest. They've got the savings account. They're contributing to their 401k because their company matches, and it would be stupid not to take free money. They're being responsible, they're doing what they were taught, they read personal finance advice that says save 10% of your income, and they do it. But they're still thinking linearly. Earn, save, maybe earn some interest, eventually retire with hopefully enough money. They're playing defense with their money, trying not to lose it, but they're not playing offense. They're not actively trying to grow it significantly. Rich people think about money in a completely different way. They think about money as a tool that can create more money. They're not just saving it in a bank account earning 0.5% interest. They're deploying it, investing it, making it multiply. They understand that money is like an employee that can work for you 24/7, doesn't take vacations, doesn't complain, and doesn't need health insurance. They ask themselves, what can I do with this money that will generate more money? Not, what can I buy with this money? Let me give you a concrete example to illustrate. More later. Person B, who's middle class and has been taught to be responsible with money, thinks, great, $10,000. I'm going to put this in my savings account where it's safe. I might need it for an emergency. I'll earn some interest on it. I'm being smart and responsible. They put it in the bank, it earns maybe 0.5% interest if they're lucky, so after a year they have $10,050. They feel good about themselves, they feel like they're adulting correctly, they're doing what financial advisors on TV tell them to do, but after accounting for 3% inflation, they've actually lost purchasing power. Their $10,000 can now only buy what $9,700 could buy a year ago. They're losing money by being safe. Person C, who understands wealth building and has an investor mindset, thinks, great, $10,000. I'm going to invest this in a diversified portfolio of index funds tracking the total stock market. Based on historical returns, I can expect about 10% average annual growth over time. They invest it, and here's what happens. After 1 year, $11,000. After 5 years, $16,105. After 10 years, $25,937. After 20 years, $67,275. After 30 years, $174,494. Same $10,000. 3 completely different outcomes. The difference isn't luck. It's not that person C had some special advantage. It's not that they had insider information or connections or a rich dad who taught them secrets. The difference is how they thought about money. Person A saw money as something to spend on lifestyle and pleasure now. Person B saw money as something to save and protect. Person C saw money as a seed that could grow into a tree that produces fruit year after year. This is the mindset shift you need to make if you want to build wealth. Money isn't just something you earn and store. It's not just something you protect. It's something you deploy strategically to create more money, which creates more money, which creates more money. You're not just a worker trading time for dollars. You're a capital allocator. You're making strategic decisions about where to deploy your financial resources to generate the maximum return. Does that sound fancy and complicated? It's not. It's actually really simple. You're just buying assets that increase in value over time instead of buying stuff that decreases in value or letting your money sit idle. And before you say, but investing is risky, I could lose everything. What if the stock market crashes and I lose all my money? Let me address that right now because this is the fear that keeps people poor. Yes, investing has risks. Your portfolio will go up and down. There will be years where you lose money. There will be market crashes that are scary. I'm not going to lie to you and say investing is risk-free because it's not. But you know what else has risks? Not investing. In fact, not investing is the biggest financial risk you can take because you're guaranteed to lose purchasing power to inflation. It's not a maybe, it's not a possibility, it's not a certainty. The question isn't whether you should take risks. You're taking risks no matter what you do. The question is which risk you want to take. The risk of your money potentially going down temporarily while invested in assets that historically grow over time, or the guaranteed risk of your money slowly becoming worthless while it sits in a savings account earning nothing. I'll take the first option every single time. And by the end of this video, you'll understand why that's the rational, smart choice. Chapter 3. The compound interest superpower that makes you rich. While you sleep, all right. Now let's talk about the single most powerful force in wealth building. The thing that will make you rich if you understand it and keep you broke if you don't. Compound interest. Albert Einstein allegedly called compound interest the eighth wonder of the world. He supposedly said, "He who understands it earns it. He who doesn't pays it." Now, historians debate whether Einstein actually said this or if it's just been attributed to him because it sounds smart and Einstein is synonymous with genius. But honestly, it doesn't matter. Whoever said it was absolutely right. Compound interest is what happens when your investment returns start generating their own returns. It's money making money making money making money. It's returns on returns on returns. It's the snowball effect applied to your wealth It's the difference between linear growth and exponential growth. Let me show you how powerful this is with some actual numbers, because this is where most people's minds get blown, and they realize they've been thinking about wealth building completely wrong their entire lives. Let's say you invest $5,000 right now just one time and never add another penny. You just invest that $5,000 and forget about it. Let's assume a 10% average annual return, which is roughly what the S&P 500 has historically returned over long periods. Some years it's way higher, some years it's negative, but over time it averages about 10%. After 1 year, you'd have $5,500. You made $500. Okay, cool, that's nice. That's a decent return for doing literally nothing. After 5 years, you'd have $8,053. You've made $3,053 in profit. Now we're talking. That's more than half your initial investment in profit. After 10 years, you'd have about $12,969. You nearly tripled your money. Your $5,000 turned into almost $13,000 without you lifting a finger, without you working extra hours, without you doing anything except waiting. After 20 years, you'd have about $33,637. Okay, now this is getting serious. You 6x'd your money. Your initial $5,000 is now worth almost $34,000. After 30 years, you'd have about $87,247 from a single $5,000 investment that you never touched, never added to, just let it sit there and compound. After 40 years, $226,296. From $5,000, you turned $5,000 into $250,000 by doing absolutely nothing except not touching it. That's the power of compound interest. The money makes money, then that money makes money, then that money makes money. It compounds, it multiplies, it snowballs. But here's where it gets really interesting, and this is the part that most people don't understand. The growth isn't linear, it's exponential, and the difference between linear and exponential growth is the difference between being comfortable and being wealthy. Look at the numbers again. In the first 10 years, you made $7,969 in profit. In the second 10 years, years 10 to 20, you made $20,668 in profit. In the third 10 years, years 20 to 30, you made $53,610 in profit. In the fourth 10 years, years 30 to 40, you made $139,049 in profit. Same rate of return every year, same 10% average. But the profit you made in the last 10 years was almost 20 times more than what you made in the first 10 years. Not because the return got better, because you had way more money in the account generating returns. This is the exponential curve. This is why compound interest is so powerful. This is why Einstein or whoever called it the eighth wonder of the world. And this is why young people have such a massive, almost unfair advantage when it comes to investing. It's not that they're smarter or make more money or have some special knowledge. They have something that money literally cannot buy: time. They have decades for compound interest to work its magic. Let me show you two scenarios that illustrate this perfectly, and if you're young and watching this should light a fire under you to start investing immediately. Scenario A. Sarah starts investing at age 25. She invests $5,000 per year for 10 years from age 25 to 35. After that, she stops completely. She doesn't add another dollar. She just lets it sit there and compound. Total amount she invested, $50,000. Scenario B, Mike starts investing at age 35. He sees Sarah doing well and decides to start. He invests $5,000 per year for 30 years straight from age 35 to 65. He's way more dedicated than Sarah. He invests for 3 times as long. Total amount he invested, $150,000. At age 65, when they both retire, who has more money? If you said Mike, that would make logical sense. He invested 3 times as much total money. He was more dedicated. He contributed for 3 times as many years. But you'd be wrong. Sarah, who only invested for 10 years early on and then stopped, ends up with about $1,142,811. Mike, who invested 3 times as much money over 3 times as many years but started later, ends up with about $822,470. Sarah wins by over $320,000 despite investing $100,000 less, all because she started 10 years earlier and gave compound interest more time to work. Those extra 10 years at the beginning, when the numbers were small, ended up being worth more than 20 years of contributions at the end. This blows most people's minds because it seems backwards. How can investing less money result in more wealth? Because time is more valuable than money when it comes to compound interest. Starting early matters more than investing more. This is why I get so passionate, borderline annoying, about telling young people to start investing now. Not tomorrow, not next month, not when you're making more money, not when you've paid off your student loans, not when you feel more secure. Now. Every single year you wait costs you tens or even hundreds of thousands of dollars in future wealth. That's not hyperbole. That's not an exaggeration. That's just math. That's just the power of compound interest working for you or not working for you. If you're in your 20s and you're watching this and you're not investing yet, you're sitting on a gold mine and you don't even realize it. You have time. You have the most valuable asset in wealth building. Don't waste it. Part 2. Understanding what you're actually investing. In Chapter 4, Stocks, owning pieces of companies, and why that makes you rich. Alright, so now you understand why you need to invest and how compound interest works. But what exactly are you investing in? What are these magical things that grow your money? Let's break down the main investment types, starting with the one everyone's heard of, stocks. A stock is literally a piece of ownership in a company. When you buy one share of Apple stock, you own a tiny piece of Apple. You're a partial owner. You're in business with Tim Cook, baby. You're part of the team that makes iPhones and MacBooks and AirPods. Now, let's be real here. You own a really tiny piece, like microscopic. Apple has about 15 billion shares outstanding, so if you own one share, you own approximately 0.00000000667% of the company. You're not getting invited to board meetings. Tim Cook isn't calling you to ask your opinion on the next product launch. But still, technically, legally, you're an owner. And as an owner, you benefit when the company does well. If Apple invents a new product that everyone wants, sales go up, profits go up, the company becomes more valuable, which means your shares become more valuable. If you bought Apple stock in 2005 at around $5 per share, adjusted for splits, and sold it today at roughly $180 per share, you just made 36 times your money. That's a 3,500% return. Your $1,000 investment turned into $36,000. That's the potential upside of stocks. You can make massive, life-changing returns if you pick the right companies at the right time. People who bought Amazon in the early 2000s, or Google when it went public, or Netflix before streaming took over, or Tesla before electric vehicles went mainstream, they made absolute fortunes. But here's the flip side, and this is important. If the company does poorly, your shares lose value. If Apple released a new iPhone that exploded in people's pockets, looking at you, Samsung Galaxy Note 7, the stock price would tank and you'd lose money. If Tesla's self-driving cars started crashing into things constantly, the stock would plummet. If Netflix lost all its subscribers to competitors, your shares would become worthless. This is why stocks are considered risky. The value fluctuates, sometimes wildly, based on how the company performs, what the economy is doing, investor sentiment, news headlines, what the CEO tweets at 3 a.m., and about a million other factors that nobody can perfectly predict. Some days your stocks will be up 5% and you'll feel like a genius. Other days they'll be down 3% and you'll wonder why you didn't just stuff your money under a mattress. Some years you'll make 30% and feel invincible. Other years you'll lose 20% and question every life decision that led you to this point. It's volatile. It's a roller coaster. It will test your emotions and your patience. But here's the key thing to understand, and this is crucial. Over long periods of time, stocks tend to go up, way up, not in a straight line, not without setbacks and crashes and scary moments. But the overall trend is upward. If you look at the S&P 500, which is an index of the 500 largest US companies, it's averaged about 10% annual returns over the past century. Some decades it did better, like the 1990s when it was up over 400%. Some decades it did worse, like the 2000s when it barely broke even. But over the long run, over 20, 30, 40 years, it trends upward. Why? Because the stock market is essentially a bet on human innovation and productivity. Companies exist to make money. They're profit-seeking entities. Smart people are constantly working to create better products, more efficient processes, new technologies that change the world. The economy grows over time. Population increases. Technology advances. Companies profit from all of this. and stock prices rise to reflect that. Yes, there are crashes. The Great Depression in the 1930s, where the market lost 90% of its value, the 1970s stagflation, the 1987 Black Monday crash, the dot-com bubble bursting in 2000, the 2008 financial crisis, the COVID crash in March 2020. These are real, scary events where people lose massive amounts of money. But every single time, without exception, the market recovered and went on to reach new all-time highs. Every single time. If you had invested in the S&P 500 at the absolute peak right before the 2008 crash, literally the worst possible timing in recent history, and you just held on through the crash without panicking and selling, you would have made your money back by 2013 and tripled your investment by 2024. If you had invested right before the COVID crash in February 2020, when everyone was panicking and the world seemed like it was ending, and you held through the crash, you would have made your money back by August 2020, 5 months later, and doubled your money by 2024. This is why time in the market beats timing the market. You cannot predict crashes. You cannot predict when stocks will go up or down. Nobody can, no matter what they tell you. But if you stay invested for decades, if you weather the storms and don't panic sell, history shows you'll come out way ahead. The stock market has survived 2 world wars, a Great Depression, multiple recessions, September 11th, the financial crisis, a global pandemic, political chaos, and countless other disasters. And it's still here, still growing, still making patient investors wealthy. Chapter 5. Bonds, the boring but stable investment. Your grandpa loves. Now let's talk about bonds, which are basically the opposite of stocks in terms of risk, excitement, and potential returns. If stocks are a roller coaster, bonds are a slow, steady escalator. A bond is essentially an IOU. When you buy a bond, you're lending money to a company or government, and they promise to pay you back with interest. That's it. That's the whole concept. Let's say you buy a 10-year U.S. Treasury bond with a 4% interest rate and a face value of $1,000. What that means in plain English is you're lending the U.S. government $1,000, and they'll pay you 4% interest every year for 10 years, then give you your $1,000 back at the end. So you'd get $40 per year in interest payments, 4% of $1,000, for a total of $400 over 10 years, plus your principal $1,000 back at maturity. Your total return would be $1,400 on a $1,000 investment. Not exciting, not sexy, not going to make you rich quick, but predictable, stable, boring in a good way. Bonds are way less exciting than stocks. You're not going to 10 times your money with bonds. You're not going to have crazy stories about how you bought bonds at the perfect time and made a fortune. You're not going to brag to your friends at parties about your bond portfolio, and if you do, you probably don't get invited to many parties. But you're also not going to have crazy losses. Your bonds aren't going to drop 50% in value in a market crash, usually. You're not going to wake up one day to find out your bonds are worthless because the company went bankrupt, if you buy government bonds. The trade-off for this stability and predictability is lower returns. While stocks average around 10% annually over long periods, bonds typically average more like 4% to 6%, depending on the type of bond and the current interest rate environment. So why would anyone invest in bonds if stocks make more money? That seems stupid, right? Why would you choose to make less money? 2 reasons: stability and diversification. Bonds are much less volatile than stocks. They don't swing wildly up and down based on news headlines or investor emotions. Your bond isn't going to lose 30% of its value because the CEO said something controversial on Twitter. This makes them useful for people who are near retirement and can't afford to lose a bunch of money right before they need to start living off their investments. If you're 64 years old and planning to retire next year, and you have $1 million in your portfolio, you cannot afford to have that drop to $500,000 in a market crash. You need stability. You need to know that the money will be there when you need it. And that's where bonds come in. They're also useful for diversification, which is a fancy Wall Street word for don't put all your eggs in one basket. When stocks go down, bonds often go up or stay relatively stable. When stocks go up, bonds might not do much. They typically have low or negative correlation, meaning they move independently or in opposite directions. This is because when the economy is doing well and everyone's optimistic, people pile into stocks trying to make maximum returns. When the economy looks shaky and people get scared, they flee to bonds for safety. It's called flight to quality. So a balanced portfolio might be 70% stocks and 30% bonds. That way you get most of the growth potential of stocks, but the bonds help cushion the blow and reduce volatility when the stock market crashes. Your portfolio might drop 20% in a crash instead of 35%. That's a big psychological difference that helps people stay invested instead of panic selling. The younger you are, the less you need bonds. If you're 25 years old with 40 years until retirement, you can afford to be 100% in stocks because even if the market crashes tomorrow and drops 50%, you have 4 decades for it to recover and then some. The short-term volatility doesn't matter when you have that much time, but if you're 60 and planning to retire in 5 years, you might want 40% or 50% bonds to protect your savings from a market crash right before you need the money. The last thing you want is to work for 40 years, save diligently, and then lose half your money in a crash the year before you retire. As you get older, you gradually shift from stocks to bonds, from growth to stability, from offense to defense. It's like a football team with a big lead in the fourth quarter. You don't keep throwing risky passes. You run the ball, protect the lead, and run out the clock. Chapter 6. Index. Funds, the lazy person's path to wealth, and why that's actually good. Alright, so stocks can make you rich, but picking individual companies is really hard and risky. You might pick the next Amazon, or you might pick the next Blockbuster or Sears, or any of the thousands of companies that went bankrupt. Bonds are stable but boring and won't make you wealthy. Is there a middle ground, something that gives you stock-like returns without requiring you to be a stock-picking genius? Yes, index funds. And this is probably the single most important investment vehicle you need to understand, because this is what will actually make you wealthy if you're a normal person with a regular job. An index fund is a fund that automatically buys a basket of stocks to match a particular index. The most popular is the S&P 500 Index Fund, which buys a little bit of all 500 companies in the S&P 500 index in proportion to their market value. When you buy one share of an S&P 500 index fund, you're instantly diversified across 500 of the largest companies in America: Apple, Microsoft, Amazon, Google, Berkshire Hathaway, Tesla, Nvidia, Meta, all of them. Tech companies, healthcare companies, financial companies, consumer goods, energy, everything. If one company goes bankrupt tomorrow, it barely affects you because you own 499 other companies. If one sector crashes, you're protected by the other sectors. If tech stocks plummet, maybe your healthcare and consumer goods stocks are doing fine. This is genius for several reasons, and once you understand this, you'll realize why most people should just invest in index funds and stop trying to be clever. First, you don't have to pick individual stocks. You don't have to research companies. You don't have to read financial statements and earnings reports. You don't have to understand price-to-earnings ratios or debt-to-equity ratios or any of that Wall Street jargon. You don't have to predict which companies will succeed and which will fail. You're just buying a piece of the entire market. You're basically saying, I don't know which specific companies will win, but I believe the American economy will continue to grow over time, so I'm betting on all of them. That's it. That's the strategy. Second, it's incredibly diversified. You're spread across 500 companies in different industries: tech, healthcare, finance, consumer goods, energy, industrials, materials, everything. This dramatically reduces your risk compared to owning individual stocks. If you had put all your money in General Electric in 2000 thinking it was a safe, stable blue-chip company that would never fail, you would have lost 80% of your money over the next 20 years as the company struggled and declined. But if you had invested in an S&P 500 index fund, GE's collapse barely affected you because it was just one of 500 companies. Third, and this is huge, it's incredibly low cost. Index funds typically charge fees called expense ratios of 0.03% to 0.20% per year. Some are even lower. Compare that to actively managed funds that charge 1% or more per year, plus sometimes additional fees like loads and 12B-1 fees and other nonsense. But wait, you might say, 1% doesn't sound like much. What's the big deal? Oh, my sweet summer child. Let me show you what that 1% costs you over time. Let's say you invest $10,000 and it grows at 10% per year for 30 years. With a 0.05% fee index fund, you'd end up with about $172,000. With a 1% fee actively managed fund, you'd end up with about $141,000. That 0.95% difference in fees cost you $31,000. Almost a third of your profit went to fees. Over 40 years? The difference is even more insane. With the low-fee index fund, you'd have $442,000. With the high-fee actively managed fund, you'd have $316,000. You lost $126,000 to fees. You literally gave away $100,000 for nothing. This is why Warren Buffett, Jack Bogle, the founder of Vanguard and creator of the first index fund, and basically every serious financial expert recommends low-cost index funds for most people. The fees matter enormously over time because of compound interest working against you. Fourth, and this might surprise you, index funds historically outperform most actively managed funds over long periods. About 80% to 90% of professional fund managers, people whose full-time job is picking stocks, fail to beat the S&P 500 over 10, 15, 20-year periods. These are people with finance degrees from Harvard and Wharton, people with teams of analysts, people with sophisticated computer models and access to information you don't have, people who do this 60-plus hours a week for their entire careers, and they still can't beat the index most of the time. Why? Because beating the market is really hard. To beat the index, you have to be right more often than you're wrong. You have to pick the winners and avoid the losers. You have to time your buys and sells well, and you have to do all this while paying higher fees that eat into your returns. Most fund managers can't do it consistently. Some beat the market for a few years and get famous, but then they underperform and everyone forgets about them. The few who consistently beat the market over decades, like Warren Buffett, are legendary precisely because it's so rare. Warren Buffett himself, one of the greatest investors of all time, literally said that when he dies, he's instructed the trustee of his estate to invest 90% of his wife's inheritance in a low-cost S&P 500 index fund and 10% in short-term government bonds. Read that again. Warren Buffett, the guy who made tens of billions of dollars picking individual stocks, is telling his wife to just buy index funds, not to hire a fancy money manager, not to buy individual stocks, not to do anything complicated, just buy index funds and chill. If Warren Buffett is telling his wife to invest in index funds, maybe, just maybe, we should listen. This is why index fund investing has become the default strategy for smart investors who aren't trying to be heroes. It's simple, it works, it's low cost, it doesn't require you to be a financial genius or spend hours researching companies, and it historically outperforms most alternatives over long periods. You just buy index funds regularly, hold them forever, ignore the noise and volatility, and let compound interest do its thing over decades. That's it. That's the entire strategy. Is it exciting? No. Will you have fun stories at parties about how you predicted the next Tesla? No. Will you feel like a genius stock picker? No. But will you become wealthy over time? Yes. And isn't that the point? Do you want to feel smart and tell cool stories, or do you want to actually build wealth? Because most people who try to feel smart by picking individual stocks end up losing money or underperforming the index. Chapter 7, Real Estate, the Other Path to Wealth, and why it's more complicated than it looks. Alright, we've talked about stocks, bonds, and index funds. But there's another major asset class that's made millions of people wealthy: real estate. Real estate is probably the most common way that regular middle-class people build significant wealth. Your parents probably own a home that's worth way more than they paid for it. Your grandparents probably bought a house for some ridiculously low amount in the 1970s that's now worth a fortune. Real estate has several advantages as an investment. First, it's tangible. You can see it, touch it, live in it. This makes it psychologically easier for people to invest large amounts of money compared to buying stocks, which are just digital entries in an account. Second, it's leveraged. This is huge, and most people don't fully appreciate this. When you buy a house, you typically put down 20% and borrow the other 80% from a bank. So if you buy a $300,000 house, you put down $60,000 and borrow $240,000. Now let's say the house appreciates 5% per year, which is roughly the historical average. After 1 year, it's worth $315,000. You made $15,000 on your $60,000 investment. That's a 25% return, not 5%, because you were leveraged. You can't do this with stocks. You can't go to a bank and say, hey, I want to buy $100,000 worth of Apple stock, but I'm only going to put down $20,000 and you lend me the other $80,000. They'll laugh you out of the building, but with real estate, this is normal. It's expected. It's how the system works. This leverage amplifies your returns dramatically. It's how people who bought houses in San Francisco or New York or other expensive cities for relatively modest amounts in the 1990s became millionaires just from their home appreciation. Third, you can live in it while it appreciates. Your primary residence generates value for you by providing shelter while simultaneously, hopefully, increasing in value. You're not paying rent to a landlord and getting zero equity. You're building wealth while you sleep in your own bed. Fourth, there are significant tax advantages. Mortgage interest is tax deductible. Property taxes are tax deductible. And when you sell your primary residence, you can exclude up to $250,000 of capital gains from taxes if you're single, or $500,000 if you're married. That's a huge tax benefit that doesn't exist with most other investments. So real estate sounds amazing, right? Everyone should just buy property and get rich. Well, not so fast. Real estate has some significant downsides and complications that you need to understand. First, it's illiquid. If you need money quickly, you can sell stocks in about 2 seconds online. But selling a house? That takes months. You have to find a buyer, negotiate, do inspections, deal with financing, close the deal. If you need cash urgently, your house doesn't help you. Second, it's expensive to buy and sell. You're paying closing costs when you buy, probably 2% to 5% of the purchase price. You're paying realtor commissions when you sell, typically 5% to 6% of the sale price. So if you buy a $300,000 house, you might pay $10,000 in closing costs. If you sell it for $350,000 a few years later, you might pay $20,000 in realtor fees. You made $50,000 on paper, but after transaction costs, you only netted $20,000. That's a big haircut. Third, it requires maintenance and upkeep. Your roof will eventually need replacing. Your HVAC system will die at the worst possible time. Your water heater will leak. Your foundation might crack. Houses are expensive to maintain, and these costs eat into your returns. Fourth, it's not actually diversified. When you buy a house, you're making a huge bet on one specific property in one specific location. If that neighborhood declines, or a factory nearby closes, and everyone moves away, or crime increases, or schools get worse, your property value could tank and there's nothing you can do about it. Compare that to index fund investing, where you own thousands of companies across the entire economy. You're diversified across industries and geographies. With real estate, all your eggs are in one very expensive basket. Fifth, it ties up a lot of capital. If you put $60,000 down on a house, that's $60,000 you can't invest in the stock market. Over 30 years at 10% returns, that $60,000 could have grown to over $1 million in an index fund. Did your house appreciate by more than that? Maybe, maybe not. So, real estate can be a great investment, but it's not automatically better than stocks. It depends on the specific property, the location, the timing, the market conditions, how long you hold it, and opportunity costs. For most people, the best strategy is to own a primary residence that you live in, which serves dual purposes of providing shelter and building equity, while also investing in stocks and index funds for true diversification and liquidity. Don't put all your money in real estate thinking it's safer or better than stocks. Don't avoid real estate entirely and just rent forever because you think stocks are better. Do both. Diversify across asset classes. Own your home. Invest in index funds. Build wealth multiple ways. Chapter 8. The investment vehicles. 401s, Ks, IRAs, and taxable accounts. Explained. Okay, so you understand what to invest in. Index funds primarily, with some bonds as you get older, and maybe real estate. But where do you actually put these investments? What types of accounts should you use? This is where most people get confused because there are so many options with weird names and rules. Let's break down the main investment account types and when to use each one. 401k, your employer's retirement plan. A 401k is a retirement account offered by your employer. It's named after the section of the tax code that created it because the government is terrible at naming things. Here's how it works. You contribute money from your paycheck before taxes are taken out. So if you make $60,000 a year and contribute $6,000 to your 401k, you only pay income taxes on $54,000. You just saved about $1,500 in taxes, depending on your tax bracket. The money grows tax-free inside the account. No taxes on dividends, capital gains, nothing. It all compounds without the government taking a cut every year. Then when you retire and start withdrawing the money, you pay income taxes on the withdrawals. The idea is that you'll be in a lower tax bracket in retirement than you are now while working, so you save money overall. The contribution limit for 2026 is $23,500 per year if you're under 50 and $31,000 if you're 50 or older. They give you catch-up contributions to help you save more if you're behind. The biggest advantage of a 401k is the employer match. Many companies will match your contributions up to a certain percentage, like 50% of the first 6% you contribute. This is free money. If you're not contributing at least enough to get the full match, you're literally leaving money on the table. Let me say that again. If your employer matches contributions and you're not contributing, you're declining free money. It's like if your boss said, "Hey, I'll give you an extra $3,000 this year if you just put $6,000 in this account," and you said, "Nah, I'm good." That's insane. The downside is that the money is locked up until you're 59 and a half years old. If you withdraw early, you pay income taxes plus a 10% penalty. There are some exceptions for hardships, but generally, the money is inaccessible until retirement. Part 3. Taking action and avoiding mistakes. Chapter 8. Continued. The investment vehicles, 401s, Ks, IRAs, and taxable accounts. Explained. IRA, individual retirement account. An IRA is similar to a 401, KA, but you open it yourself, not through your employer. There are two main types, traditional IRA and Roth IRA, and understanding the difference is crucial because it affects how much money you'll actually have in retirement. A traditional IRA works like a 401k. You contribute pre-tax money, it grows tax-free, and you pay taxes when you withdraw in retirement. The contribution limit for 2026 is $7,000 per year if you're under 50 and $8,000 if you're 50 or older. But here's where it gets interesting. The Roth IRA. A Roth IRA is the opposite. You contribute after tax money, meaning you don't get a tax deduction now, but then the money grows tax-free forever. And when you withdraw it in retirement, you pay zero taxes on it. Not on the contributions, not on the gains, nothing. Let me illustrate why this is so powerful. Let's say you're 25 years old and you max out a Roth IRA every year for 40 years, contributing $7,000 per year. That's $280,000 in total contributions. At 10% average annual returns, by age 65, you'd have about $3.5 million. With a traditional IRA, you'd owe income taxes on that $3.5 million when you withdraw it. At a 25% tax rate, you'd pay $875,000 in taxes. You'd net $2.625 million. With a Roth IRA, you pay zero taxes. You keep the full $3.5 million. That's an $875,000 difference. Now you might say, but with the traditional IRA, I got a tax deduction every year, so I saved money up front. True, you saved about $1,750 per year in taxes, assuming 25% tax bracket on $7,000 contribution. Over 40 years, that's $70,000 in tax savings, but you gave up $875,000 in future taxes to save $70,000 now. That's a terrible trade. This is why Roth IRAs are so powerful, especially when you're young and in a lower tax bracket. The catch is that Roth IRAs have income limits. If you make too much money, you can't contribute directly to a Roth. For 2026, the limit is around $161,000 for single filers and $240,000 for married couples. These numbers adjust for inflation each year. But there's a workaround called a backdoor Roth that high earners can use, which involves contributing to a traditional IRA and immediately converting it to a Roth. My recommendation, if you're eligible for a Roth IRA, max it out every single year. This should be your priority after getting your employer 401k match. The tax-free growth is just too powerful to ignore. HSA, the secret retirement account nobody talks about. Here's one that flies under the radar, but is actually one of the best retirement accounts available: the Health Savings Account, HSA. An HSA is technically for healthcare expenses, but it's also a retirement account in disguise. Here's why it's amazing. You contribute pre-tax money, like a traditional IRA, it grows tax-free, like all retirement accounts, and you can withdraw it tax-free for qualified medical expenses, like a Roth IRA. It's triple tax advantaged. Nothing else in the tax code offers this. The contribution limit for 2026 is $4,300 for individuals and $8,550 for families. And here's the secret strategy that smart people use. Don't use your HSA money for current medical expenses. Pay those out of pocket if you can afford it. Instead, invest your HSA money in index funds and let it grow for decades. Then in retirement, when you inevitably have medical expenses, because everyone does when they're old, you can withdraw the money completely tax-free. Even better, after age 65, you can withdraw HSA money for non-medical expenses and just pay income taxes on it, like a traditional IRA, so it functions as an extra retirement account. The only catch is you need a high-deductible health plan to be eligible for an HSA, but if you're young and healthy and don't use healthcare services much, a high-deductible plan often makes sense anyway because the premiums are lower. Taxable brokerage account, your overflow account. After you've maxed out all your tax-advantaged retirement accounts, 401k, IRA, HSA, where do you put additional money you want to invest? A taxable brokerage account. This is just a regular investment account with no special tax benefits, but also no contribution limits and no restrictions on withdrawals. You can invest as much as you want, you can withdraw any time without penalties, and you have complete flexibility. The downside is you pay taxes on dividends and capital gains each year, which reduces your returns compared to tax-advantaged accounts. But here's why taxable accounts are still valuable. Flexibility. Maybe you want to retire before 59 and a half. Maybe you want to save for a house down payment. Maybe you want to build wealth but keep the option to access it before retirement. A taxable account gives you that flexibility. Plus, capital gains tax rates are actually pretty favorable. If you hold investments for more than a year, you pay long-term capital gains tax, which is 0%, 15%, or 20% depending on your income. That's way better than ordinary income tax rates, which go up to 37%. So the optimal strategy is this: max out your 401k to get the employer match, max out your Roth IRA, max out your HSA if eligible, then if you still have money to invest, put it in a taxable brokerage account. This gives you a mix of tax advantages and flexibility. Chapter 9. The actual step-by-step process to start investing today. Alright, enough theory. Let's talk about exactly what you need to do step by step to start investing today. I'm going to hold your hand through this entire process because I know it's intimidating the first time. Step 1. Figure out how much you can invest. Before you invest anything, you need to know how much money you have available. Here's the priority order. First, have an emergency fund of 3 to 6 months of expenses in a high-yield savings account. This is non-negotiable. You cannot skip this step. If you don't have an emergency fund and something goes wrong, car breaks down, lose your job, medical emergency, you'll be forced to pull money out of your investments at the worst possible time or go into debt. Second, pay off any high-interest debt. If you have credit card debt at 20% interest, pay that off before investing. You cannot outinvest 20% interest. It's mathematically impossible. Third, now you can invest. Look at your monthly budget and figure out how much you can consistently invest every month. Maybe it's $200. Maybe it's $500. Maybe it's $1,000. Whatever it is, the key word is consistently. You're better off investing $200 per month for 30 years than investing $1,000 per month for 3 months and then stopping. Step 2. Open the right accounts. Now you need to open investment accounts. Here's where to go. For your 401k, check if your employer offers one. Talk to HR or check your employee benefits portal. If they offer a match, contribute at least enough to get the full match. If they offer a Roth 401k option, even better, use that. For an IRA, you need to open one with a brokerage firm. The 3 best options are Vanguard, Fidelity, and Charles Schwab. All 3 are excellent, low-cost, reputable firms. You can't go wrong with any of them. Go to their website, Click Open an Account, select IRA, choose Roth if you're eligible, and follow the steps. You'll need to provide your social security number, employment information, and bank account details to transfer money. The whole process takes maybe 15 to 20 minutes. For an HSA, if your employer offers one, use that. If not, you can open one yourself at places like Fidelity or Lively. For a taxable brokerage account, same process. Go to Vanguard, Fidelity, or Schwab, click Open an Account, select Individual Brokerage Account, and follow the steps. Step 3. Transfer money into your accounts. Once your accounts are open, you need to put money in them. Link your bank account to your investment accounts and transfer money. For your 401k, set up automatic payroll deductions. Your employer will take the money out of your paycheck before you even see it and deposit it directly into your 401k. For your IRA and other accounts, you can either transfer a lump sum if you have savings or set up automatic monthly transfers from your checking account. I strongly recommend automatic transfers because it removes the decision making and ensures consistency. Step 4. Actually buy investments. This is where people get stuck. They open accounts, transfer money, and then the money just sits there in cash earning nothing because they're paralyzed by choice and don't know what to buy. Here's what you buy: index funds. Specifically, total market index funds, or S&P 500 index funds. That's it. That's the whole strategy. At Vanguard, you'd buy VTSAX, Vanguard Total Stock Market Index Fund, or VTI, the ETF version, or VFIAX, Vanguard S&P 500 Index Fund, or VOO, the ETF version. At Fidelity, you'd buy FSKAX, Fidelity Total Market Index Fund, or FXAIX, Fidelity S&P 500 Index Fund. At Schwab, you'd buy SWTSX, Schwab Total Stock Market Index Fund, or SWPPX, Schwab S&P 500 Index Fund. All of these are essentially the same thing: low-cost index funds that give you exposure to the entire U.S. stock market or the largest 500 U.S. companies. Pick one. It doesn't matter which one. They'll all perform nearly identically. Type the ticker symbol into the search box, click Buy, enter the amount you want to invest, and confirm. Boom. Done. You're now an investor. You own a piece of thousands of companies. Step 5. Set up automatic investments. This is the most important step and the one that will actually make you wealthy. Set up automatic investments so that every month, money automatically transfers from your bank to your investment account and automatically buys more index funds. Most brokerages have an automatic investment plan feature. Set it up once, and then it happens on autopilot forever. You never have to think about it, never have to remember to do it, never have to make a decision. This is what separates people who become wealthy from people who stay broke. The wealthy automate their investing, so it happens no matter what. They pay themselves first. They invest before they have a chance to spend the money. Step 6. Ignore your accounts and live your life. This might sound counterintuitive, but once you've set up automatic investing, you should mostly ignore your accounts. Don't check them every day. Don't obsess over every up and down. Don't panic when the market drops. Check in maybe once a quarter to make sure everything is working properly and your contributions are happening. Once a year, rebalance if needed, but otherwise just let it run on autopilot. The more you check your accounts, the more likely you are to make emotional decisions that hurt your returns. The more you watch CNBC and read financial news, the more likely you are to panic and sell at the wrong time. Set it and forget it. That's the strategy. It's boring, it's not exciting, but it works. Chapter 10. The biggest mistakes that will destroy your wealth. Now let's talk about the mistakes that will sabotage your investing success. These are the psychological traps that cause people to lose money even when they're trying to do the right thing. Mistake number 1. Trying to time the market. This is the most common and most expensive mistake investors make. They try to predict when the market will go up and when it will go down, buying when they think it's low and selling when they think it's high. The market seems really high right now. I'll wait for a crash to invest. The market is crashing. I should sell before I lose more. This stock is going up. I should buy more. This stock is going down. I should sell. All of these are attempts to time the market, and they almost never work. Why? because predicting short-term market movements is essentially impossible. If it were possible, every professional investor would be a billionaire, but they're not, because they can't predict it either. Studies show that missing just the 10 best days in the market over a 20-year period reduces your returns by more than half. The problem is those best days often happen right after the worst days during volatile periods when everyone is panicking. If you sold during the crash because you were scared, you probably missed the recovery, and then you're sitting on the sidelines with cash while the market goes up without you, and eventually you buy back in at higher prices than you sold for. This is why time in the market beats timing the market. Stay invested through the ups and downs and you'll do fine. Try to be clever and time it, and you'll probably underperform. Mistake number 2, panic selling. During crashes related to timing the market, but specific enough to deserve its own section, panic selling during market crashes is the single best way to destroy your wealth. Here's what happens. The market drops 20%, 30%, 40%. Maybe there's a recession, a pandemic, a financial crisis, whatever. Everyone is panicking. The news is apocalyptic. Your portfolio is down massive amounts. It feels terrible. Every instinct in your body is screaming, get out before you lose everything, and if you listen to that instinct, you lock in your losses, you sell low, and then when the market inevitably recovers, you miss it because you're too scared to get back in. The people who became wealthy are the ones who held through the crashes, or even bought more. Warren Buffett has a famous quote, "Be fearful when others are greedy, and greedy when others are fearful." When everyone is panicking and selling, that's actually the best time to buy because everything is on sale. When everyone is euphoric and buying, that's when you should be cautious. But emotionally, this is incredibly hard to do. It goes against every instinct. You need to train yourself to see market crashes not as disasters, but as opportunities to buy investments at discount prices. Mistake number 3, paying too much in fees. We talked about this earlier, but it bears repeating. Fees destroy wealth over time. A 1% difference in fees doesn't sound like much, but over 30 to 40 years, it can cost you hundreds of thousands of dollars because of compound interest working against you. This is why you should almost always choose low-cost index funds over actively managed funds. The 0.03% expense ratio of an index fund versus the 1% expense ratio of an actively managed fund is a massive difference that compounds over decades. Also, be wary of financial advisors who charge high fees. Some charge 1% of your assets under management per year. On a $500,000 portfolio, that's $5,000 per year. Over 20 years, that's $100,000 in fees, not counting the lost compound growth on that money. For most people, you don't need a financial advisor at all. Just buy low-cost index funds and hold them. If you do need advice for complex situations, find a fee-only fiduciary advisor who charges by the hour, not a percentage of your assets. Mistake number 4, not diversifying. Putting all your money into one stock, one sector, or one type of investment is incredibly risky. Maybe you work for Apple and you get stock options, so your entire net worth is tied up in Apple stock. What happens if Apple struggles? You lose your job and your investments tank simultaneously. That's a nightmare scenario. Or maybe you're convinced that tech stocks are the future, so you put everything into tech. What happens when tech has a bad decade, like it did in the 2000s? You're screwed. This is why diversification matters. Spread your money across thousands of companies, across different sectors, across different geographies. Index funds do this automatically, which is why they're so powerful. Don't try to be a hero and pick individual stocks, unless you're doing it with a small portion of your portfolio that you're willing to lose. The core of your portfolio should be diversified index funds. Mistake number 5, investing money you'll need soon. The stock market is volatile short-term but reliable long-term. If you invest money you'll need in 6 months or a year or even 3 years, you're gambling, not investing. What happens if you invest $10,000 that you need for a house down payment next year and the market crashes 30%? Now you only have $7,000 and you can't buy the house. That's bad. Only invest money you won't need for at least 5 to 10 years, preferably much longer. Money you'll need soon should be in a high-yield savings account or money market fund, not in stocks. Mistake number 6, letting emotions drive decisions. Fear and greed are the two emotions that destroy investor returns. Fear makes you sell low. Greed makes you buy high and take stupid risks. The best investors are emotionless. They stick to their plan regardless of what the market is doing or how they feel about it. They're robots executing a strategy, not emotional humans reacting to news headlines. This is another reason why automatic investing is so powerful. It removes emotions from the equation. The money gets invested automatically whether you're feeling optimistic or pessimistic about the market. Chapter 11. The Psychology of Staying Rich. Why most people can't do it. Let's talk about something that doesn't get discussed enough, the psychology of staying rich. Because here's the thing, accumulating wealth is actually the easy part. The math is straightforward. Invest consistently in low-cost index funds for decades, and compound interest will make you wealthy. Simple. The hard part is not sabotaging yourself along the way. The hard part is resisting the psychological traps that cause people to blow their money despite having good intentions. The lifestyle inflation trap. This is probably the biggest wealth killer, and it's invisible to most people. Here's how it works. You start your career making $50,000. You live in a modest apartment, drive a used car, and cook most of your meals at home. You're investing $400 per month. Then you get promoted. Now you're making $70,000. Suddenly you can afford a nicer apartment in a better neighborhood. You upgrade your car. You start eating out more. You buy nicer clothes. You take better vacations. Then you get promoted again. Now you're making $100,000. You buy a house in an expensive area because you can afford it. You finance a luxury car because you've earned it. You upgrade your lifestyle across the board, and even though you're making twice as much as before, you're still only investing $400 per month. Or maybe you stopped investing altogether because now you need all your income for your lifestyle. This is lifestyle inflation, and it's why doctors making $300,000 per year are often just as broke as people making $50,000. They spend everything they make. The antidote is this. When your income increases, increase your investment rate, not just your lifestyle. If you get a $20,000 raise, invest $10,000 of it and spend $10,000 on lifestyle improvements. That way, you're still improving your quality of life while also accelerating your wealth building. The comparison trap. Social media has made this worse, but it's always existed. You compare yourself to others and feel like you need to keep up. Your friend buys a Tesla, so you feel like you should upgrade your car. Your coworker goes on an expensive vacation to Europe, so you feel like you should too. Your neighbor remodels their kitchen with all high-end appliances, so your kitchen feels inadequate. This is the comparison trap, and it will destroy your wealth faster than almost anything else. Because there will always be someone with more than you. Always. If you're trying to keep up with everyone around you, you'll never build wealth, because you'll spend everything trying to maintain appearances. The solution is to stop caring what other people think. Stop comparing. Focus on your own goals and your own path. Maybe your friend has a Tesla, but they're also $50,000 in debt and living paycheck to paycheck. Maybe your coworker took that expensive vacation on credit cards that they'll be paying off for years. You don't know other people's financial situations. You only see the surface. And often, the people who look richest are actually broke, while the actual millionaires are driving 10-year-old Hondas and living in modest houses. The I deserve this trap. This is a subtle one, but it's dangerous. You work hard. You feel like you deserve to reward yourself. You've been saving and investing, so what's the harm in splurging a little? I worked 60 hours this week. I deserve this $200 dinner. I've been so disciplined with my budget, I deserve to buy this thing I don't really need. I got a bonus. I deserve to treat myself. The problem is, this thinking compounds. One splurge becomes regular splurges. Small indulgences become big ones. And before you know it, you're spending thousands of dollars per month on stuff you deserve that's preventing you from building wealth. I'm not saying never reward yourself or enjoy life. I'm saying be intentional about it. Build treats and enjoyment into your budget. But don't let I deserve this become an excuse for undisciplined spending that sabotages your financial goals. The short-term thinking trap. Our brains are wired for short-term gratification. We want pleasure now, not 30 years from now. This is why investing is so psychologically difficult. When you invest $500, you're choosing not to spend that $500 on something enjoyable today. You're delaying gratification for decades. That's really hard, but here's how to reframe it. You're not giving up $500. You're trading $500 today for $5,000 or $10,000 or more in the future. You're making an investment in your future self. Would you rather have a $500 dinner tonight that you'll forget about in a week, or $10,000 in 20 years that could pay for an entire month-long vacation? When you frame it that way, the choice becomes obvious. Train yourself to think long-term. When you're tempted to spend money on something frivolous, calculate what that money could become if you invested it instead. That $50 shirt could be $500 in 20 years. Is it worth it? Sometimes yes, sometimes no, but at least you're making an informed decision. Chapter 12. Advanced Strategies. Once you've mastered the basics. Okay, you've got the basics down. You're investing consistently in low-cost index funds, avoiding the major mistakes, and staying psychologically disciplined. What's next? Here are some advanced strategies to optimize your wealth building. Tax loss harvesting. This is a strategy where you intentionally sell investments that have lost money to offset gains from investments that have made money, reducing your tax bill. Here's how it works. Let's say you invested in a total market index fund and it's up $10,000, so you have a $10,000 capital gain. If you sell, you'd owe capital gains tax on that $10,000. But let's say you also invested in an international index fund and it's down $3,000. If you sell that at a loss, you can use that $3,000 loss to offset your $10,000 gain, so now you only owe taxes on $7,000. Then immediately after selling the international fund, you can buy a similar, but not identical fund to maintain your asset allocation. You've reduced your tax bill without changing your investment strategy. This only works in taxable brokerage accounts, not in retirement accounts where you don't pay taxes annually anyway. And you have to be careful about the wash sale rule, which says you can't buy the exact same investment within 30 days of selling it for a loss. Some brokerages like Wealthfront and Betterment offer automatic tax loss harvesting, which can add 0.5% to 1% to your after-tax returns over time. That might not sound like much, but over 30 years it adds up to tens of thousands of dollars. The mega backdoor Roth. Remember how Roth IRAs have contribution limits of $7,000 per year? There's a strategy called the Mega Backdoor Roth that allows some people to contribute way more than that, potentially $40,000 plus per year to a Roth account. Here's how it works. Some 401k plans allow after-tax contributions beyond the normal $23,500 limit, up to a combined employee and employer total of about $70,000. If your plan allows this and also allows in-plan Roth conversions, you can contribute after-tax dollars to your 401k and immediately convert them to Roth, essentially creating a giant Roth contribution. This is complex and not everyone's 401k plan allows it, but if yours does and you have the income to max it out, it's one of the most powerful wealth-building strategies available because you can get hundreds of thousands or even millions of dollars into a Roth account that will never be taxed again. Geographic arbitrage. This is a strategy where you earn money in a high-income area but live in a low-cost area, or work remotely for a high-paying company while living somewhere cheap. For example, you could work remotely for a San Francisco tech company making $150,000 per year while living in a low-cost state like Texas or Florida, where your expenses are half what they'd be in San Francisco. Or you could work hard and save aggressively while living in an expensive city early in your career, then retire early and move to a low-cost area where your money goes much further. Some people take this even further and move to low-cost countries like Portugal, Mexico, Thailand, or Colombia, where they can live very comfortably on $2,000 to $3,000 per month, making their retirement savings last much longer. Real estate investment trusts, REITs. If you want exposure to real estate without actually buying property, dealing with tenants, fixing toilets, and all the headaches of being a landlord, you can invest in REITs. A REIT is a company that owns and operates real estate, and by law, they have to pay out 90% of their taxable income as dividends to shareholders. You can buy REIT index funds and get exposure to hundreds of commercial properties, apartment buildings, shopping centers, office buildings, etc. This gives you the diversification and income benefits of real estate without the hassle of actually being a landlord. Many experts recommend having 5 to 10% of your portfolio in REITs for diversification. Part 4. Mastering the Mental Game and Building Lasting Wealth. Chapter 13. The Real Reason. Most people fail at investing and how to be different. Let's talk about something that nobody wants to admit. Most people who start investing eventually quit or sabotage themselves. They start with good intentions, they set up their accounts, they make their first investments, and then somewhere along the way, they fail. Why? Because investing isn't actually about math or strategy or picking the right funds. Those things are easy. Investing is about psychology. It's about behavior. It's about consistently doing boring things for decades, even when it feels pointless. Let me tell you about the real enemy of wealth building: yourself. Your brain is actively working against you when it comes to investing. Evolution designed your brain to keep you alive, not to make you rich. Your ancestors who were overly cautious, who hoarded resources, who panicked at signs of danger, those were the ones who survived long enough to pass on their genes. The ancestors who took big risks, who were calm during crises, who thought long-term instead of worrying about immediate threats. A lot of them got eaten by predators or starved during famines. So you're literally walking around with a brain that's designed to make you bad at investing. Your instincts tell you to sell when markets crash, because loss aversion is hardwired into you. Your instincts tell you to buy when markets are soaring, because FOMO is a survival mechanism. Your instincts tell you to spend money now rather than save for a future that might never come. This is why discipline beats intelligence when it comes to building wealth. You don't need to be smart to become a millionaire. You need to be disciplined enough to do the boring, unsexy work of investing consistently for decades, despite what your emotions are screaming at you. Let me give you some specific psychological traps and how to overcome them. The paralysis of choice. There are thousands of investments you could choose from: stocks, bonds, ETFs, mutual funds, real estate, crypto, commodities, forex, options, futures, on and on. When you're confronted with too many choices, your brain freezes. It's easier to do nothing than to choose wrong. This is called analysis paralysis, and it keeps people from ever starting. They think, I need to research more, I need to learn more, I need to understand all my options before I invest. And they never actually invest because there's always more to learn. Here's the solution: embrace simplicity. You don't need to understand every investment option, you just need one or two low-cost index funds, that's it. Stop researching. Stop watching YouTube videos comparing different funds. Just pick one and start. Vanguard Total Stock Market Index Fund. Done. That's your entire investment strategy. You can literally stop reading right now and go invest in that one fund and you'll be fine. The difference between that fund and any other broad market index fund is so minuscule that it will have virtually no impact on your wealth over your lifetime. But the difference between investing in any fund versus not investing at all because you're paralyzed trying to find the perfect fund, that's millions of dollars. Perfect is the enemy of good. Good enough is actually good enough when it comes to investing. The excitement addiction, social media, and financial news have created a culture where people think investing should be exciting. They see posts about someone making 1,000% on some crypto coin or options trade, and suddenly their boring index fund returning 10% per year feels inadequate, so they start chasing excitement. They start trading individual stocks. They start buying whatever's trending on Reddit. They start making risky bets trying to hit it big, and almost all of them lose money. Because exciting investing is usually bad investing, the best investors are bored. Warren Buffett is bored. Jack Bogle was bored. The strategy that actually builds wealth is so boring that it can be explained in one sentence: buy low-cost index funds regularly and hold them forever. That's not exciting. That's not going to make for interesting stories. You're not going to be posting screenshots of your 10,000% gains on social media, but you're going to be wealthy. If you need excitement in your life, get a hobby. Go skydiving, take up rock climbing, start a side project. But don't gamble with your retirement money trying to feel a rush. Here's a rule: if your investment strategy makes your heart race, you're doing it wrong. Investing should be as boring as watching paint dry. That's how you know you're doing it right. The recency bias. Your brain gives too much weight to recent events and assumes they'll continue into the future. This causes terrible investment decisions. When stocks have been going up for years, everyone thinks they'll keep going up forever. This time is different, they say. We're in a new paradigm. So they pile in at the top right before a crash. When stocks have been going down, everyone thinks they'll keep going down forever. The economy is doomed, they say. This is the end. So they sell at the bottom and miss the recovery. This pattern repeats over and over throughout history. People buy high when they feel optimistic because recent returns have been good. People sell low when they feel pessimistic because recent returns have been bad. The solution is to ignore recent performance completely. Don't check how your investments did this month or this year. It doesn't matter. What matters is what they'll do over the next 20, 30, 40 years. And here's what we know from history. Over long periods, stocks go up. Not in a straight line, not without scary drops, but up. So stop trying to predict short-term movements based on recent data. Just stay invested and let time do its work. The comparison game. You're going to see other people making more money than you, faster than you. Someone's going to brag about how they made $50,000 trading options. Someone's going to post about how they bought a house that doubled in value in 3 years. Someone's going to show off their crypto gains. And you're going to feel like a chump with your boring index fund that's up 10% for the year. Don't fall for it. Here's what you don't see: the survivorship bias. You're seeing the winners brag, but you're not seeing the hundreds of people who tried the same strategy and lost everything. You're not seeing the person who lost $100,000 trading options. You're not seeing the person whose crypto went to zero. You're not seeing the person whose rental property turned into a money pit. For every person who gets rich taking big risks, there are dozens who go broke. But the ones who go broke don't post about it on social media. They quietly slink away and you never hear from them again. Meanwhile, boring index fund investing works for basically everyone who does it consistently. It's not flashy, it's not impressive, but it has like a 95% success rate if you stick with it for decades. Would you rather have a strategy that gives you a 5% chance of getting rich quick and a 95% chance of losing money, or a strategy that gives you a 95% chance of becoming a millionaire if you're patient? I know which one I'd choose. Chapter 14, the lifestyle design that supports wealth building. Let's talk about something that doesn't get enough attention. Your lifestyle and environment matter enormously for your ability to build wealth. You can have the best investment strategy in the world, but if your lifestyle constantly drains your money, you'll never accumulate enough to invest. This isn't just about making a budget and cutting expenses. This is about designing a life that naturally leads to wealth accumulation without feeling like you're constantly depriving yourself. The 50-30-20 rule, modified for wealth building. You've probably heard of the 50-30-20 budget rule. 50% for needs, 30% for wants, 20% for savings and debt repayment. It's fine, but it's not aggressive enough if you want to build serious wealth. Here's my modified version: 50-20-30. 50% for needs, housing, food, utilities, transportation, insurance. 20% for wants, entertainment, dining out, hobbies, travel. 30% for wealth building, investments, additional debt repayment beyond minimums, emergency fund. Notice I flipped the wants and wealth building percentages. Most people default to spending more on wants than they save. You need to flip that if you want to build wealth faster. Now, if 50% for needs seems impossible because you live in an expensive city or have other circumstances, you have to make hard choices. Either increase your income, decrease your needs by making lifestyle changes, move to a cheaper place, get a roommate, drive a cheaper car, or accept that wealth building will be slower. There's no magic here. Math is math. If you spend 80% of your income on needs and wants, you can only save 20%. If you want to save more, you have to spend less or earn more. Those are your only options. The geographic arbitrage decision. Where you live has an enormous impact on your ability to build wealth. If you live in San Francisco or New York City, you might pay $3,000 per month for a one-bedroom apartment. If you live in a mid-sized city in the Midwest or South, you might pay $800 for the same quality apartment. That's a $2,200 per month difference. That's $26,400 per year. Invested at 10% returns over 30 years, that's over 4.7. Million. Where you live could literally be the difference between retiring a multimillionaire or struggling financially your entire life. Now, I'm not saying everyone should move to the cheapest possible place. Quality of life matters, career opportunities matter, being near family and friends matters. But you need to be intentional about this decision. If you're living in an expensive city because you love it and the lifestyle, great. But make sure you're factoring in the real cost. You're not just paying more rent. You're giving up potentially millions in future wealth. If you're living in an expensive city just because that's where you ended up, or because you think you're supposed to, seriously consider moving. The financial impact is enormous. Or here's an idea: spend your high-earning years in an expensive city maximizing your income, save and invest aggressively, then retire early and move somewhere cheap where your money goes further. Best of both worlds. The car. Decision that makes or breaks wealth. Let's talk about cars, because this is where so many people destroy their wealth without realizing it. The average new car costs about $48,000. If you finance it with a 5-year loan at 6% interest, you're paying about $930 per month. Over 5 years, that's $55,800 total. But wait, it gets worse. Cars depreciate rapidly. That $48,000 car will be worth maybe $25,000 after 5 years. You just spent $55,800 to own something worth $25,000. You lost $30,800. Now, what if instead of buying that new car, you bought a reliable used car for $15,000 cash? Something like a 5-year-old Honda Civic or Toyota Corolla. You avoid the loan, you avoid the depreciation hit, and you save the difference. That $930 per month you're not spending on a car payment, invest it. Over 30 years at 10% returns, that's over $2 million. $2 million. That's what the new car really costs you, not $48,000. $2 million in lost wealth. But everyone justifies their car purchase. I need a reliable car. I deserve something nice. A car is necessary for my work. All true, probably. But you can have a reliable, nice car that's necessary for your work without spending $48,000 on it. The wealthy understand this. They drive cars that are 5 to 10 years old and perfectly functional. They don't care what other people think. They care about building wealth. The broke pretend to be rich by driving expensive cars they can't afford. The rich pretend to be broke by driving old Hondas while they accumulate millions in investments. Which would you rather be, looking rich or being rich? You can't have both unless you actually are rich. The housing trap. Everyone's been told that buying a house is the key to building wealth, that rent is throwing money away, and that homeownership is the American dream. And there's some truth to that, but it's way more complicated than people think. First, let's bust a myth. Your primary residence is not really an investment. It's shelter that hopefully appreciates, but it's not generating cash flow unless you rent out rooms. You're not diversified, all your eggs in one basket, and you can't easily sell part of it if you need money. Buying a house only makes sense if you're planning to stay in the area for at least 5 to 7 years. You can afford the down payment without depleting your emergency fund, and the monthly payment is comparable to or less than what you'd pay in rent. If you're moving cities in a few years for your career, buying is probably dumb because of transaction costs. If you can barely afford the down payment, you're leaving yourself vulnerable to emergencies. If the monthly payment is way more than rent, you're paying a premium for ownership that might not be worth it. Here's a dirty secret. In many markets, you're actually better off renting cheaply and investing the difference between rent and what a mortgage would cost, especially if you're young and might need to move for career opportunities. Run the numbers for your specific situation. Don't just assume buying is always better. Sometimes it is, sometimes it isn't. The kid cost calculation. Let's talk about something controversial. Kids are expensive, and if you want to build wealth, you need to factor this into your life planning. The USDA estimates that raising a child from birth to age 18 costs about $310,000, and that's before college, which could be another $100,000 to $300,000 depending on where they go. That's not a judgment about whether you should or shouldn't have kids. That's just math. Kids are one of the most expensive life decisions you'll make, and if you have multiple kids, we're talking about potentially $1 million or more. If you want kids and building wealth, you need a plan for how to afford both. Maybe you wait to have kids until your career is more established and you're earning more. Maybe you have fewer kids. Maybe you're strategic about where You live and where your kids go to school to reduce costs, or maybe you decide kids are more important than wealth, and that's fine. That's a valid choice. But make it consciously, knowing the trade-offs rather than accidentally sabotaging your financial future. Chapter 15. The Advanced Tax Strategies the Rich Use, and you can too. Let's talk about taxes, because how much you pay in taxes has an enormous impact on wealth building. The difference between paying 30% in taxes versus 15% over a career is hundreds of thousands or millions of dollars. The tax code is complicated on purpose. It's full of loopholes and strategies that benefit people who know how to use them. Most people just pay whatever their employer withholds and never think about optimization. That's leaving a ton of money on the table. Here are some strategies to legally reduce your tax bill. Maximize all tax-advantaged accounts. We talked about 401s, Ks, IRAs, and HSAs, but let me emphasize how powerful. These are for tax reduction. If you're in the 24% tax bracket and you contribute $23,500 to a 401k, you save $5,640 in taxes that year. If you max out a Roth IRA at $7,000, that money grows tax-free forever, potentially saving you hundreds of thousands in taxes over your lifetime. If you max out an HSA at $4,300, that's another $1,032 in tax savings, plus tax-free growth, plus tax-free withdrawals for medical expenses. Just by maxing out these three accounts, you're saving over $6,600 in taxes per year. Over 30 years, that's $200,000 in taxes you didn't pay, not counting the compound growth on that money. Most people contribute nowhere near the max to these accounts. They're leaving free money on the table. The qualified dividend and long-term capital gains advantage. Not all income is taxed the same. Ordinary income from your job is taxed at regular income tax rates, which go up to 37% federally. But qualified dividends and long-term capital gains, investments held more than a year, are taxed at preferential rates, 0%, 15%, or 20% depending on your income. This means if you're in the 24% tax bracket for ordinary income, you might only pay 15% on your investment gains. That's a huge difference. This is why tax-efficient investing matters. Hold your investments for at least a year to get long-term capital gains treatment. Focus on index funds that don't generate a lot of taxable distributions. Keep tax-inefficient investments like bonds and retirement accounts, and tax-efficient investments like stocks in taxable accounts. Rich people understand this. They structure their income to maximize capital gains and minimize ordinary income. That's why billionaires often pay lower tax rates than middle-class workers. It's not necessarily tax evasion, it's tax optimization. The Roth Conversion Ladder. Here's an advanced strategy for people who want to retire early before 59 and a half, the Roth Conversion Ladder. The problem with early retirement is your money is locked up in retirement accounts until 59 and a half. If you withdraw early, you pay a 10% penalty plus income taxes, but there's a loophole. You can convert money from a traditional IRA to a Roth IRA at any time, paying income taxes on the conversion. Then 5 years later, you can withdraw that converted money from the Roth IRA with no penalty, even if you're under 59 and a half. So if you retire at 45, you can start converting $40,000 per year from traditional to Roth, paying taxes on it. 5 years later, at age 50, you can start withdrawing that money penalty-free. As long as you keep doing conversions, you have a pipeline of money you can access every 5 years. This requires planning and living on other savings for the first 5 years, but it's how many early retirees access their retirement accounts before the official retirement age. The donor-advised fund strategy. If you give to charity, you should be using a donor-advised fund. Here's how it works. You contribute appreciated assets like stocks that have gone up in value to a donor-advised fund. You get an immediate tax deduction for the full fair market value of the assets. The assets are sold inside the fund with no capital gains tax. Then you can recommend grants to charities over time. The advantage, you get a big tax deduction now. You avoid capital gains tax on the appreciated assets, and you can spread the charitable giving over multiple years. Let's say you have $50,000 in stocks that you bought for $10,000. If you sold them and donated the cash, you'd pay capital gains tax on the $40,000 gain, so maybe $6,000 in taxes. Then you donate $44,000 and get a $44,000 deduction. But if you donate the stocks directly to a donor-advised fund, you get a $50,000 deduction and pay zero capital gains tax. You just saved $6,000 in taxes while giving the same amount to charity. This is what wealthy people do. It's perfectly legal and available to anyone. The small business tax advantages. This could be a whole video itself, but if you have any kind of side hustle or freelance income, you have access to business deductions that W-2 employees don't. Home office deduction, vehicle expenses if you use your car for business, equipment and supplies, travel expenses for business purposes, retirement contributions to a solo 401k or SEPIRA that are way higher than regular contribution limits. Even a modest side business that makes $10,000 per year could save you thousands in taxes through legitimate business deductions. I'm not saying to commit tax fraud. I'm saying if you have legitimate business expenses, deduct them. The tax code allows it. You're just playing by the rules. Chapter 16. The generational wealth mindset. Building wealth that lasts beyond you. Let's talk about something most people never think about. Building wealth that outlasts you. Not just getting rich yourself, but creating financial security for your kids, your grandkids, and beyond. Most people think, I just want to have enough for retirement. That's fine, that's a good goal. But if you can expand your thinking beyond your own lifetime, you can create incredible outcomes for your family. The compounding across generations. Here's a thought experiment. Let's say you invest $10,000 for your newborn child in a Roth IRA and never add another dollar. At 10% returns, by the time they're 65 years old, that $10,000 becomes $4.8 million, tax-free. You gave your child $4.8 million with a one-time $10,000 investment. That's the power of starting early and compounding over decades. Now take it further. What if your kid does the same thing for their kid, and that kid does it for their kid? With just a $10,000 gift at birth, you could create a dynasty of millionaires in your family line. This is how generational wealth works. It's not about leaving your kids a huge inheritance. It's about teaching them to invest, starting them early, and letting compound interest do the work across multiple generations. The gift tax exclusion. Did you know you can give up to $18,000 per person per year as of 2024 without any gift tax consequences? A married couple can give $36,000 per person. This means you could contribute $18,000 to a custodial investment account for your kid every year, and it grows in their name, outside of your estate. Do this for 18 years and you've gifted $324,000 that compounds tax-free for them. Rich families use this to transfer wealth to the next generation while minimizing estate taxes. You can use it to give your kids a massive head start. The education funding debate. There's a big debate about whether you should save for your kids' college or save for your own retirement first. Here's my take. Save for retirement first. Why? Because there are loans for college, but there are no loans for retirement. Your kids can get financial aid, scholarships, work study, student loans. But if you reach retirement age broke, you're screwed. You'll be a financial burden on your kids, which defeats the purpose of sacrificing your retirement to pay for their college. The best thing you can do for your kids is to be financially secure yourself so they never have to support you in old age. Second best is to teach them about money and investing so they can build their own wealth. Third is to help with college if you can afford it without compromising your retirement. Also, a dirty secret, your kids don't need to go to an expensive private college. Community college for 2 years then transfer to a state school is a perfectly fine education for a fraction of the cost. If they want to go to an expensive private school, they can take out loans or earn scholarships. I know this is harsh, but spending $200,000 on an undergraduate degree when you're not financially secure is not a good decision. It's emotional, not rational. The money conversations you need to have. If you want to build generational wealth, you need to actually talk to your family about money. This is uncomfortable for most people because we're taught that money is private and taboo to discuss. But how are your kids supposed to learn about investing if you never talk about it? How are they supposed to understand wealth building if you hide your finances from them? Have age-appropriate conversations about money, teach them about saving and investing when they're young, Show them your investment accounts when they're teenagers. Explain compound interest and why you're investing. Involve them in financial decisions. The wealthy do this. They have explicit conversations about family wealth, investment strategies, and financial values. They teach their kids financial literacy as a core life skill. The poor never talk about money except to complain about not having enough. Then their kids grow up with the same lack of financial knowledge and repeat the cycle. Break the cycle. Be the first generation in your family to build real wealth and pass down financial knowledge along with it. Conclusion: the reality of becoming wealthy. Let's bring this all home and talk about the reality of building wealth through investing. First, the brutal truth. This isn't going to happen overnight. You're not going to get rich in 6 months or a year or even 5 years. This is a decades-long process that requires patience, discipline, and consistency. You're going to invest month after month, year after year, and for a long time it's going to feel like nothing is happening. You'll look at your account and see maybe $5,000 or $10,000 or $20,000 and think, at this rate, I'll never have enough to retire. But then something magical happens. Compound interest starts to accelerate. The snowball gets bigger. Your investments start making more money than you're contributing. You look at your account one day and realize you have $100,000, then $250,000, then $500,000, then eventually 7 figures. And when you get there, you'll realize it was all worth it. All those times you chose to invest instead of spend, all those times you resisted lifestyle inflation, all those times you stayed invested through market crashes when everyone else was panicking, it all paid off. But you have to start. That's the key. Most people never start. They think about investing, they watch videos about investing, they read articles about investing, but they never actually open an account and buy their first index fund. Don't be that person. Be the person who takes action today. Not tomorrow, not next week, not next month. Today. Here's what I want you to do right now. As soon as you finish watching this video, go to Vanguard, Fidelity, or Schwab's website. Click Open an Account. Choose a Roth IRA if you're eligible, or a traditional IRA if you're not. Fill out the application. Link your bank account. Transfer money. Buy a total market or S&P 500 index fund. Set up automatic monthly investments. Do this today. It will take you 30 minutes, maybe less. Those 30 minutes could be worth millions of dollars to your future self. Because here's the thing, the difference between people who become wealthy and people who stay broke isn't intelligence. It's not luck. It's not having a high income. It's taking action. The broke person watches this video, thinks that's interesting, and does nothing. Their life doesn't change. The wealthy person watches this video, immediately opens an investment account, and starts building wealth. Their entire life trajectory changes. Which person are you going to be? I'll tell you something else. A lot of people are going to watch this video and think of reasons why they can't start investing. I don't make enough money. I have too much debt. I need to figure out my budget first. I'll start next year when I'm making more. These are all excuses. I'm not saying they're not real concerns, but they're excuses nonetheless. You don't need to be making 6 figures to start investing. You don't need to have your entire financial life perfectly organized. You don't need to wait until everything is perfect. Start with what you have, where you are, right now. Even if it's just $50 a month, even if you can only afford to invest $25 per week, start. The most important thing is building the habit, establishing the behavior, getting momentum. You can always increase your contributions later as your income grows, but you can never get back the time you wasted waiting for the perfect moment to start. And here's something that should motivate you. Every day you don't invest is a day of compound interest you're losing forever. Every month you delay is costing your future self thousands of dollars. Every year you wait is costing you tens of thousands. Time is your most valuable asset when it comes to investing, and you're burning it every day you don't take action. So take action. Today, right now, open that account, make that first investment, start building the wealthy version of yourself. Your future self, the one sitting on a pile of money, financially independent, not stressing about bills, able to retire when you want instead of when you're forced to, that person is going to thank you for starting today. Or your future self, the one still working at 70 because you can't afford to retire, stressing about money, regretting that you never started investing when you were young. That person is going to wish you had watched a video like this and actually taken action. Which future do you want? The choice is yours, and it starts with what you do in the next hour. I believe in you. I believe you can do this. It's not complicated. It's not some secret knowledge. It's simple, it's proven, and it works for anyone who commits to it. So go make it happen. Open that account, buy that first index fund, set up automatic investments, and then come back in 20 or 30 years and tell me how much wealth you build. I'm rooting for you. Now stop watching videos and go take action. Thanks for watching. If you found this valuable, hit the like button, subscribe for more content like this, and drop a comment letting me know you're committing to start investing today. I want to hear from you. I want to know you're actually doing this. And remember, the best time to start investing was 20 years ago. The second best time is today. Don't wait another day. Your wealthy future self is depending on you. Now go make it happen.